Forced onto the FAIR plan? That's kind of a question, kind of a statement. Why are low-risk homes losing insurance? I get stories from you guys all the time. Hey, my house is miles and miles and miles away from a high-risk area, and we just got our insurance shut down. We can't renew. We got to go find somebody else, or we got to go into the state plan. And it's not just California. Today, we're going to look at a California story from CBS. Let's get into it. Here we go. This is mainly a video piece, so that's what we're going to do. Watch video. Remember in high school, and they bring the AV system in, and you get to watch a video? Yeah. Well, here we go.
California's insurance of last resort is supposed to be for homes with high wildfire risk. But our CBS News California data analysis finds the vast majority of homes on the FAIR plan are in zip codes that the insurance companies classify as low risk, indicating anyone can be forced onto the FAIR plan. And the numbers are increasing.
I love it, baby. I love it.
I do too.
For Ken and 𝗧𝗜𝗠, their new house in West Roseville is the dream.
But hopefully we can get insurance.
I know.
That's quickly
Hopefully.
a nightmare.
Oh.
I hope to God.
When 𝗧𝗜𝗠 called to transfer their insurance to the new house,
They said, I'm sorry, you're denied. And I was in shock. I thought, are you kidding me? He's been on their insurance for 30 years. And we've never
New
had
couple.
any problems. We've never had any claims.
and they're only moving 3 minutes away.
And that's why it was shocking that they said they wouldn't insure this.
This is a really interesting scene. I'm gonna do this one back, but this drone reveal shot kind of gives you the perspective of there are no trees, there's no wildfire brush, there's no nothing, there's just housing after housing after housing. I mean, this is not, in the foothills of the mountains. Let's keep going.
House.
Any idea what could be high risk about this?
No clue. I was so surprised. I thought they were making a mistake, actually.
But it's no mistake. Turns out 𝗧𝗠𝗠 and Ken's insurer is among several major insurers that stopped writing new policies in California, meaning they're struggling to find an insurer for their new home, and the people buying their old home can't find insurance either.
Most people have mortgages, so they have to have insurance with that mortgage.
The only options?
That's a super important point. Why does this matter? Well, I just don't get insurance. Well, you want to have $1 million asset with no insurance on it? Probably not. Plus, it's not negotiable. If you have a mortgage, you're going to have to provide a policy to your lender. You're going to have to insure their asset because it's their asset until you pay it off. You just own it with massive leverage. 20% down payment. Well, they own 80, you own 20. So it's not a negotiable deal. It is one of those things where you got to have it. It's period.
A risky, unregulated, out-of-state insurer, or the California FAIR Plan, the state's insurance of last resort, which is expensive and doesn't cover much.
It's just a frightening time to be buying homes, living in homes. Even renters are going to have their problems.
The FAIR Plan was intended for homes with high wildfire risk, but a CBS News California data analysis finds most of the homes on the FAIR Plan are in the lowest risk zip codes according to the insurer's fire risk classification.
Let's look at that. Need that negligible in there. Look at those numbers. The one on the red that you can't see because my ridiculous circle is covering it, that's the high risk. Good percentage in the moderate. I mean, it's about a third. And then you got this tiny little bit over here that is yellow. Red. Sorry. Colorblind. I'm not. Look at the biggest portion of it is in the negligible area. 160,000 homes. These numbers right here kind of tell you everything that you need to know. We're not talking risk here. We're talking ability to make money in a California's insurance environment. And the insurance companies are saying, yeah, we don't care. We're getting out. We're out.
Higher risk classification, like Ken and 𝗧𝗠𝗠's, which gets just a 0.34 on the insurer's 4-point scale. In fact, we found there are 10 times more homes in low-risk zip codes than high-risk on the FAIR Plan. And while some are being forced into the FAIR plan because they can't get new policies, others are losing their existing fire policies.
We share a roof, we share this wall.
Like Helen.
The same risk factors.
Her Palisades duplex survived the fire, but just weeks before, she was forced onto the FAIR plan. State Farm renewed her neighbor's fire policy, but not Helen's.
It's totally random.
That's wild. Yeah, not so much. And literally, that was, I don't know if that's a condo or is it a single lot, attached PUD, whatever you want to call it. You got a property line running right down the middle of that wall line, and you got the, units on each side. You couldn't have more proximity to insured and then not insured, right? I mean, that is the poster child for these insurance companies are just going I guess we'll keep you going. I mean, you got those other policies with us that we're making a lot, so we'll keep you going. But you just got the one homeowner's insurance policy. So yeah, you got your car insurance with somebody else. So screw you. We're not insuring you because, California, we don't make enough money. We can't charge enough. That is literally what this story is kind of headed towards here.
And while there may be some high-risk homes here, on average, the insurers also classify Helen's Palisades zip code as relatively low risk. Why are so many low-risk homes being non-renewed?
It's a canary in the coal mine that there is a much bigger problem going on.
Rex Frazier represents the insurance industry.
They should be asking, why in the world does the FAIR plan have 500,000 policies in it?
Because insurers are non-renewing policies. Why are they non-renewing policies?
Because we have a system in California that has not allowed companies to earn enough money to do business everywhere.
Insurers argue.
So policy in California has capped the ability for insurance companies to jack up their rates. And it's become so bad, it's such an onerous process for the insurance companies to protect the consumer that insurance companies just for decades have not gone through the state's process with the insurance industry, with the insurance commission to get their rates hiked up. They're going through one now, and it's just been this incredibly complex process because California is trying to protect the consumer. And what is happening to the consumer? They're having their policies canceled, and their coverage is becoming more expensive, and they're getting less coverage, and folks don't know if they can get coverage moving forward on even low-risk homes because the cost of doing business for the insurance companies, what they're saying is that it's too expensive, and they don't have the ability to charge what they need to keep the ball rolling in California.
That California's strict insurance regulations have prevented them from charging enough to cover their risk, so they had to start cutting policies. Californians spend on average less for homeowners insurance than people in 19 other states, even though our home values and the cost.
Number 20 on the list. What does that tell you? And they've got to have some of the highest risk overall, right? I mean, they just do. So they're not paying much. But that is the essence of the cost, is that, yes, you're not paying much, but good luck getting that policy renewed. Good luck getting that new policy. Because you're paying so little, the insurance companies are saying, go screw yourself. We're not playing ball. Just business, right? Capitalism. If you can't make a profit, you're out. You dip out. Okay. All right.
To rebuild are much more expensive. Now, home insurers are still profitable in California, but a CBS News California data analysis reveals profitability has declined, and insurers rely on profits to replenish their reserves, which are also dwindling. They need reserves to cover claims after big events, like the LA fires. So you're saying if we were paying more right now for insurance, we wouldn't be in this situation?
That's 100% what I'm saying. I've been saying that for years. How can we simultaneously say we're in a changing climate, we have really expensive homes that are built next to a lot of burnable things, and then act like, oh, there's going to be no impact on rates? That's ridiculous.
Well, new regulation.
That's California Democrat liberal leadership for you. Ignore reality and just keep going down the same pathway. It'll work out just fine. And then be shocked when you look back and go, God, there's no insurance companies left. What happened? right? I mean, that's literally what we're in the midst of right now. How did this happen? This has been going on for decades and decades. This doesn't happen overnight. All the policies that California is putting in place, it's all layered on top of each other. And you've just got so many mind-numbingly stupid policies that now you've got an environment where it's becoming difficult to get insurance. I mean, and it's not funny for folks dealing with that factor, but it's like there's cause and effect. And at times it rears up its ugly head and goes, here we are. This is what we're doing. And this is literally what California is doing, and other states, not just California. Has to do with risk, right? Because insurance, all that is they roll the odds on whether your house is going to burn. Nah, it's not. Okay. But even if there's, not much of a chance that it's going to burn and they can't charge as much, charging 20 down on the line, why would they do business in your state? They wouldn't. And that's what they're doing.
Will soon let insurers charge more in California. And in exchange, insurers are supposed to write more policies for people on the FAIR plan. But here's the catch. The regulation specifies only people on the FAIR plan who the insurers classify as moderate to high wildfire risk. Remember, we showed you, according to the insurers, most people on the FAIR plan live in low-risk zip codes. So the regulations may not help everyone on the FAIR plan.
It's outrageous. The whole point of the regulations were to get people off their FAIR plan.
Consumer watchdog's Jamie Court was surprised by our findings and notes insurers can now pass the cost of the FAIR plan on to all of us.
When you crunch the numbers, as you have, it shows there is no incentive to get people off the FAIR plan.
Now, it's important to note that these new regulations do incentivize insurers to write new policies across California. Separate from the FAIR plan, insurers can also write new policies in areas that the Department of Insurance has categorized as distressed. Take a look at the map. That includes most of Northern California, meaning insurers can write new policies anywhere here. They don't have to be for people on the FAIR plan. But notably, places like Palisades, Altadena, most of Southern California are not considered distressed.
It undermines the entire purpose of allowing them to raise rates based on these intangible factors.
And there's no telling who might be forced onto the FAIR plan next.
Everybody's at risk. You don't get comfortable with your insurance company right now because they can drop you like that.
Ken works at the Capitol and is a freelance news photographer for CBS Sacramento, so he and Lisa know more than most about how politics work.
We need to figure out how all these leaders and insurance companies are going to come together and say, okay, this is what's best.
Leaders and insurance companies come together and figure out what's best in California? All right. Okay. I mean, that is a pipe dream at best. Right? I mean, we've seen the example after example. I mean, just 10 ways from Sunday, how California leadership just picks the wrong route, no matter what it is, even if it's a super easy decision. Let's go down that one because that, it's for the people, but it makes no sense. Right? There's an absolute abandon of reality, which is we're going to keep rates low. We're going to force these companies to keep their rates low and we're going to force them to give us insurance. And then they're like, no. And then you got the state insurance stepping in with the FAIR plan. And then now the FAIR plan is bankrupt. It's insolvent. And you got to go to the other insurance company and say, give us $500 million. We need $500 million. And all states having to ask its a parent company, State Farm Auto. They have to ask State Farm Auto hey, can you chip in $500 million? You got all kinds of nonsense going back and forth. And it's because leadership has dictated that in order to protect the consumer, this is what we're doing. And this has been predicted for decades that this is the end result. And now we're here at the end result. And people are like, you need to get the insurance folks together with our leaders and figure this thing out. That's not going to happen. The insurance companies are going to say, we need XYZ amount of money. And the state's going to go, good Lord, they're going to triple their rates. Well, that's what they should have been paying. And that's why we dipped out. So figure it out, folks. No clear answer on this one. There's going to be no answer. And the answer is everybody's insurance rates go up. Bottom line, right?
Now, this is a rare situation where after seeing our data, both representatives for the insurance industry and consumer advocates agreed they would support updates to the regulation that would incentivize insurers to write new policies for anyone on the FAIR plan. We've shared our findings with the Department of Insurance. Stay tuned.
Welcome.
Stay tuned. Okay. You know, the other crazy story that's going on right now is gasoline. And in fact, here's a really good one. California's new green scam, not even gas. New green scam could cost you $20,000. That's just the absolute dollar amount per family, including low-income families in California, that all the ridiculous, nonsensical green BS is going to cost folks. Here's another one. California, let's go back here. California's gas prices could skyrocket 75%, $8.43 a gallon. I'm going to be covering this one in a full podcast. This is what experts, don't you love that when you reference an expert? Expert. This guy says, well, gas could go to $8.43 a gallon as refineries close. California has ratcheted down so hard on what kind of gas you can use in the state because of this environmental nonsense that you've got refineries who are saying, Valero was the most recent one where they said, yeah, all options are on the table with this one refinery, or a couple of refineries, was it? And, we're probably just going to close that one over there because we don't want to do business in California. So you've only got a handful of refineries left in California. Again, it made all these decisions, gone down all these roadways. Critics have said it's going to cost way more for gasoline in California than any other state. And that's literally what's happening. And now leadership is looking around and you know, you've got Newsom talking about, well, there's price gouging going on. Price gouging is code word for the market has spoken and California gets screwed because there's no price gouging. Because otherwise it would happen to all the other states as well. It's not just, we really hate California, we're going to screw California. No, it's they're pulling out of California. And because California has a special blend gasoline that you can only use in California, can't be made elsewhere, bring that oil in. And if you bring that oil in from, say, the Middle East, you bring it on in one of these oil ships that is horrible for the environment, probably the absolute worst for the environment. And yet we're doing this all in the sake of climate, whatever. It's crazy. It's another example of, well, we're going to do this to protect the environment. We're going to do this to protect the consumer. And then it backfires because it's not based in reality. It's just not based in reality. None of this stuff is based in reality. None of this stuff has to do with business decisions. Well, if the business entity can't make a profit, they're out. They dip out. Not that hard to figure out. If you constrict the supply of gasoline, is gas going to go down in price? If you went through 8th grade economics, you'd understand. Well, there's less refineries now, and you got to have refineries because California requires their own special blend, their own special herbs and sauces, right? And now you don't have enough refineries to make that happen. You got less gasoline? What's going to happen with the cost of gas in California? To the moon. Not that hard to figure out. But for some reason, folks in California just keep going down the same road of let's do this. This is going to work out. Somehow this is going to work out. It's going to work out all right. Just not the way that leadership thinks it will. And then they'll be going, what can we do here? How do we get the insurance executives together with leadership and make this happen? Yeah, you don't. You're stuck with it. You're screwed. All right. So, for all those folks out there, this could be an absolute mad scramble for insurance because we just covered just the California FAIR plan, not what's going on with folks who want a regular insurance policy. Because the FAIR plan covers very little as far as the coverage on your property, and it's very expensive, but you can get it versus not having insurance from a regular standard, from your regular Allstate, from your State Farm, from your Farmers Insurance. That's considered private insurance, right? Relative to the state plan. So how's this going to go down? Gas prices in California are going to go up. And leadership will say, it's because big oil is screwing the consumer. Well, what's the price of gas in Florida? What's the price of gas in Oklahoma? What's the price of gas in Texas? What's the price there? Yeah, all right. Get back to me on that. Thanks so much for being here. That's it for me. I'll catch up with you in the next one. Bye for now.